Good evening. It's March 10th, Thursday, 6:49 p.m. Welcome to episode 36. Sit tight, Buttercup. Good evening to you, Wowie.
Good evening, Mark.
And good evening to our listeners. I hope everyone is safe. Our thoughts goes out to those Ukrainians and everyone, all civilians that are in harm's way. This is your host, Mark Yu.
And Wavi Santos.
And welcome to the Mark Yu and Wowie Show. Disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wowie are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. And for those who have missed it, episode 35, we just recorded it a week ago. We discussed the stock market weekly sentiments as what we're going to dive into in a little bit. The fund flows. We also discussed Morgan Stanley's top stock picks during turbulent times. And we also briefly discussed the worldwide sell-off of Russian stocks. So in this episode, we're going to go ahead first with our weekly Roll the Clip segment. We're going to start first with Morgan Stanley's Mike Wilson. This was just recorded this morning by CNBC. It garnered 3,500 views so far. And let's play the clip.
Strategist and Chief Investment Officer for his thoughts on what is to come. Mike, it's always great to get your thoughts. You made that call prior to there being any sort of war on continental Europe. And so do you think, you haven't put out a note yet, but do you think that the risk is really to the downside of even your target?
Yeah, thanks for having me, Melissa. Yeah, look, I think, as you said, we came into this year not that optimistic because obviously the Fed was going to have to tighten due to the inflationary spike. And of course, now growth is slowing as you described. And, the Russia's invasion of Ukraine only makes those two conditions worse, right? Because you now have more inflation, so they can't really back off. I would say, one thing about geopolitical events like this, normally, you want to rush in and maybe buy these events, but at this time I think it's different because the central banks are kind of hamstrung, right? Normally they would flood the system with liquidity. They can't do that this time, and it's also going to have a negative impact on growth. So yeah, I think it's a much easier kind of thing to say now that we're going to trade sub 4,000. It was more difficult back in January to make that call, but I think now it's kind of a fait accompli. And look, you all are saying it on the show. You're market veterans. You see what's going on under the surface, whether it's high yield, the breadth of the market, what the leadership has been. It's been very defensive. So the market's screaming at us, and we're not complete yet. Dan said it right. The market's priced incorrectly at 19 times. We've had an 18 multiple. That was when we were more bearish than most. And I would suggest we probably overshoot that sometime this spring.
What is the biggest risk to the markets right now, Mike? What do you think is going to be the number one driver to the downside to your target?
Well, clearly, this situation in Russia, Ukraine is front and center. Nobody knows which way it's going to go. We're all hoping that it calms down. I have no insight whether that's going to be the case. I'm praying for that. So hopefully that fades. And then I think the market will focus on what it always focuses on, which is earnings in the U.S., right? Because look, the U.S. market is somewhat distanced from this situation geographically and financially. There's going to be ramifications indirectly. However, I think earnings are going to slow anyway. That's been our call. So whether this situation calms down or not, we still have to face, I think, negative earnings revisions across a lot of sectors, particularly consumer, maybe some of the financial system now, given what's going on in Europe, and of course technology, which there's just going to be payback in demand. That's starting to play out. It's been playing out. It was playing out before this invasion.
In your notes, Mike, you put boring is beautiful, and there's nothing more boring than railroads, although I happen to love them, by the way. I was a kid. I used to love them on a railroad. That's neither here nor there. You look at some of these names. Union Pacific, last I looked, is making an all-time high. Reasonable valuation, and companies that are far more efficient energy-wise than some of these trucking names. I'm not looking to play stock market here, but does that make sense for railroads in this environment?
Yeah, absolutely. And look, we call this year the year of the stock picker. And I think that's what you got to do. You got to find businesses you think are somewhat protected from the issues that we're facing, who have either pricing power or they don't have issues that other companies are facing. And that may be one example. I don't have any railroad names off the top of my head that I love, but structurally that makes sense to me. And then look, this environment is changing, right? Obviously defense stocks, maybe security stocks. I think oil services, which is going to maybe enter a structural bullish period because we underinvested. I mean, there are things that are happening from this unfortunate incident, which is going to help some companies. That's what you got to do. You got to bob and weave here a little bit and find the new opportunities, not rest back. It's going to be the same old type of market because it's not.
Mike, great to get your thoughts. Thank you so much.
All right, that goes for Morgan Stanley's Chief Investment Officer, Mike Wilson. So now we're going to jump on Mr. Tom Lee. This interview just happened today as well.
Mr. Bullish.
Mr. Bullish, looks like Wall Street loves this guy, and
I love that guy.
And YouTube as well. It's almost almost garnered 30,000 views, whereas Morgan Stanley's interview just garnered 3,500 views. Yes, so let's roll the clip.
Demanding.
Hey, Carl. When we look at valuations, I think there's a couple of simple measures to look at. One is something like median market PE, so that the median stock in the S&P, and that multiple's 16.5 times forward earnings now. It was almost 20 times at the end of 2019. So the stock market, even though we're 2 years or 3 years really almost past the pandemic start, the multiples actually declined. And in terms of free cash yield, it's the same story. That free cash flow yield on the median stock now is 5.8%. The 10 years under 2%. So you're still getting paid a pretty hefty premium to own equity. So I know stocks are kind of in no man's land because of a lot of uncertainty, including the war and this sort of surge in inflation. But the fact that market valuations aren't causing you to have a huge margin of error on the downside means, I just think you can't really get that hurt if you buy stocks here over the next 12 months.
Right. You're beginning to spin out a bit of a narrative. I mean, Yellen's on the tape right now talking about whether or not there's a path for further sanctions given the horrible offensive we saw yesterday. But it does sound, though, that you're beginning to hear from world leaders the limits of sanctions because of the collateral damage. Am I right?
That's right. What's pretty apparent now is that the sanctions have caused oil to spike and commodity prices to spike. So it's now delivering a pretty big blow to the rest of the world. So even anyone outside the conflict is now paying the price because food and energy's gotten expensive. So it just shows you the sanctions are essentially becoming a game of relative pain. Is Russia going to suffer more pain than the rest of the world? But I'm not sure it's a great strategy to actually continue to add sanctions that cause further inflationary pressures.
Hey, Tom, it's Deirdre. Good morning. You've seen a number of hedge funds increase their cash positions. Are you, despite sort of a 7% annualized rate of inflation, is this a smart move for the average investor?
I think the foundation for the bull market is still intact. I'd say the best sort of arbiter of that is the yield curve has been steepening to 10-year versus 30, even the 2s versus 10. And if that's the case, then what we're really experiencing, even with inflation, is a spike in commodities that are now working its way through the system. And it's as painful as it is very different than being in a secular structural inflation problem. And so, I think it's painful now. Even today's CPI report, as you guys just mentioned, one of the sort of glimmers is that used car prices, which was over half of that rise in CPI last year, is starting to decline. So things that were, viewed as sort of enormous risk to the market in terms of continuing to add pressure are diminishing. And that could be the case for CPI really over the next 12 months.
So, Tom, do you hold on to more cash?
Well, I think we are in a no man's land for the moment. Our base case for first half 2022 was that markets would be treacherous. This is far more treacherous than we expected. And I think it's, of course, because we're in wartime conditions. But do I think stocks will end higher from here on an absolute basis? Yes. I think even though we're at S&P 4,200, I think we could still exit this year with 5,100 or higher.
Woo. So 5,100 or higher by next year. In contrary to Morgan Stanley is below or
That's a good point, Scott.
or sub 4,000 in next coming months. What do you think, Wawi?
Well, we don't know the future, but it's down, down, down. So maybe the only direction is up, up, up next.
Yeah, at this point in time, yeah, it's been a rocky week, as we're going to see next in our slides, as we're going to take a look at sentiments and other fund flows and other miscellaneous charts that had pop up in the past week. So we're doing this, as a review as well, and how to guide our investment strategy moving forward. So, just a brief recap: Mike Wilson is already pessimistic in coming to this year, and he's now I guess doubling down on his call that we're going to end up with sub 4,000 in the S&P 500. So that's the 500 largest companies in the USA. So right now at 4,200, if we're going to trade less than 4,000, that's going to be another 10% to 12% drop at this point in time, which is going to be definitely painful for most of the investors who are staying long in this market.
Yeah,
And
if we're basing our reaction on the market sentiment at
right.
this point, at this point of time, it's likely gonna follow further downtrend once the Fed rate hike occurs, if it does, on March 16.
Yes, it's gonna come up soon. It's wow, less than a week from now, and we're gonna hear finally from the Fed that they're gonna raise some, interest rates in the coming
So
few days.
I'm kind of waiting for that to happen. I
Mhm.
can't say I'm excited, but I'm looking forward to seeing what the market sentiment will be when the Fed rate starts going up.
Right. And if you're gonna stick with Mike Wilson's, defensive type of approach, he's actually recommending the stalwarts, the companies that are reliable. As we have discussed in the previous episode, we shared the Morgan Stanley's top investment picks. On this interview, he said, he was asked specifically about railroads, the boring businesses compared to trucking businesses, and he said that this is the year of the stock pickers, and he's also bullish on oil services. As our listeners may have observed, oil has been skyrocketing, and right now the administration is looking for assistance from each corner, even in other countries, in terms of producing more oil, in so
Mhm.
as to control the skyrocketing price. So for Tom Lee, the ever bullish Wall Street
Mhm.
personality, he's saying that the stock market in general is actually cheaper at this point in time when you're
It
going to look at
is.
its forward earnings ratio. It's much cheaper now compared to the end of 2019, when the COVID, started popping up in China, and then eventually went here and then globally. So he said that you cannot get hurt if you buy stocks here over the next 12 months. And
You
he's
may
also Mhm.
you may get pinched.
You might get pinched. But that's what he said last week too. Before he said that it could be that we have already reached the lows last week. So we even went lower than what last week had, indicated. So he's also shared his
Mhm.
thoughts on the ongoing sanctions. It's becoming a relative pain, where now we are experiencing even more increasing inflation, and far more treacherous at this point in time due to the scenario there in Eastern Europe. So now we're gonna jump onto our weekly sentiments. This is the survey that we always take a look at weekly, the American Association of Individual Investors sentiment. If people are bullish or bearish, bullish means that they think the stock market will go up. Bearish means going down. So for March 9th, people have gotten less bearish compared to last week. From 30.4 last week, we're down to 24%. For bearish, people got more bearish. From 41.4 last week, we're up to 45.8. For the volatility, this is the up and down moves, the swings in the stock market or the S&P 500. Interestingly, despite the up and down motion for the past 5 days, we ended today, Thursday, down 11% for the
Mhm.
volatility. And since the start of the year, we're almost doubling our volatility. It's been ever so increasing since January 1st. For the volatility of NASDAQ index, which consists of the top 100 technology companies. We're up 2.7%, not so much for the past 5 days. And since the start of the year, we're up 62%. And if we're going to take a look at the options market, people are still bearish at this point in time. The put call ratio is still up there compared to its average. We're falling around between 0.7 and 0.9. We're now above 0.9, or still at least since the start of the year. So people are still defensive, reflecting the bearish sentiment. So since the start of the week, all major market indexes here in the USA are down. Dow Jones, which consists of the top 30 companies that they picked in their index, is down negative 1.8. S&P 500 major indices, if you're invested via retirement fund, this is usually the main tracker, it's down 2.4%. NASDAQ 100, the major loser among the three, down 3%. So if you have tech stocks in your portfolio, it hasn't been a good week. Since the start of the year, NASDAQ is still the worst performing index, down 16.7%. At one point, I think we have entered the bear market, where it was down 20% since its peak back in November. And if we're gonna look at different sectors of the market for the past week, unsurprisingly, energy as a sector is the outperforming sector, up 2.8%, followed by utilities at 1.5%. And the rest of the sectors like real estate, healthcare, industrials, financial, technology are down. Worst performing is consumer defensive, down 4.4%. Since the start of the year, there are only two sectors in Wall Street that are up. First is energy, up 27%. Basic materials is up 1.9%, and the rest are down in the red. So if you have technology in your portfolio, it hasn't been a good year. It was down negative 18% since the start of the year. And for the first time, we're going to include some of the commodities that are flashing in our screen right now. Well, kind of like, well, it was taken as a screenshot. So for the past 5 days, W1 or wheat is down 14.6%. So contrary to what's happening in Russia right now, there have been sanctions, and Ukraine is one of the top exporter of wheat. So people would be expecting increase in its price, but it's actually down 15% for the past 5 days. XB1 or gasoline, we may have thought that it should be skyrocketing by now, but it's actually down 4% since the start of the week. Interestingly, so that should slowly reflect in our gas stations. Hopefully, some of these gas stations start, reducing appropriately their market price for their gasoline.
At least in the US, but I think in Asia it's going up.
It is, yes,
Yeah. Mhm.
because of the import pressures and probably tariffs along the way. So
Mhm.
XAU or gold, let's see where it's at. Gold is up 2.4% since the start of the year. So, since for the past 5 days, I apologize. Since the start of the year, CL1 or West Texas Intermediate Oil, or the price used here in the US to trade, is up 43%. XB1 gasoline prices is up 42%. W1 or wheat, wow, this is where it hurts. Wheat is up 36%. And gold is up 11%, followed by silver up 9%. So these are the indices. We already discussed the S&P 500, but we're going to take international indexes. Worst performing so far in this snapshot is Moscow's index. It's down 36%. And right now, actually, nobody's trading Moscow since it's already excluded in the stock market. Followed by Nikkei. Japan's index is down 12%. It's not been a good year then for Buffett, I guess, or other investors who have shifted some of their investments to Japan at this point in time. Hang Seng Index or Hong Kong is down nearly 11%. S&P 500 down 11%. Shanghai, China is down 9.4%. And UK FTSE or United Kingdom index is actually down 3.8%, 3.9% almost. So for our miscellaneous charts, we're just going to take a closer look at crude oil. Obviously, crude oil, a barrel it had reached 130 barrels on Monday. The crude oil stocks, which is quite alarming. So as you can see here, for the past 3 years, we have always been in that range in the gray mark. But at this point in time, we no longer are in the range. We're a lot less in terms of stocks, crude oil stocks. So that would indicate possible higher prices in the near future per barrel.
Mhm.
Domestic production, even though you can see here since last October, oil producers here in the US are slowly ramping up their production. So they're heeding what the administration is requesting and they're trying to make up for it. So even though that they're trying their best, we're still hovering now less stocks in oil here in the US. So more inflation for sure.
Well, at least in Texas, I can feel that there's more more movement towards the oil rigs because I'm seeing some workers are applying for jobs in the oil rigs at this time
That's a good sign. More
here in
jobs,
Texas. Mhm.
more jobs, more prosperity. So this is a Bloomberg article that was just published today, 8:46 a.m. It's entitled "Inflation is Rising Faster Than Pay for Many American Workers." New
That's the
research
problem.
Yep. New research finds many lower income earners are looking to tax refunds to ease financial pressures. So it's not quite a good impression if we're going to take a closer look in numbers. So inflation adjusted weekly earnings actually fell 2.3% compared to last year, whereas um, inflation has increased by 10.6%. So right now, a low wage earner or average person is down. If you're gonna add 10.6 plus 2.3, it's down nearly 13% in terms of buying power compared to last year, which isn't a good sight. Right now, what I'm thinking, Wowie, since we've been reporting of the consumer index sentiment from Michigan, um, we've been reporting that we've been discussing that it's been going down since late last year, but nonetheless the consumer spending is still up. So I'm thinking it's because despite them feeling down, they still have ample money in their savings to buy stuff. That's
And they
why.
have to, and people have to,
Mhm.
especially consumer staples. And a lot of them are new homeowners too, so they
Right,
have to.
regardless
Uh,
of the price, they have to keep spending. And credit card information or credit card spending, according to one of the surveys we have just discussed a couple podcasts ago, is still climbing. So people have their risk appetite despite their low sentiment in spending. So this is an article that just came up as well this afternoon from Bloomberg. It says Russia bans export of 200 products after suffering sanctions hit. So restrictions cover items previously imported to Russia from medical, and the government said on its website, from medical equipment and agricultural machinery to railway cars and turbines. The ban applies until the end of this year. So just to take note, Russia is a commodity giant. Raw materials coming
mhm.
from Russia to global trade consists of crude petroleum, refined petroleum, gas, iron, steel, aluminum, precious metal gems, coal, and cereals. So it's going to hit everyone who's heavily dependent on Russia for sure. So,
Well, did you hear about last Tuesday when the London Metal Exchange had to stop trading on nickel because
yes,
nickel more than doubled in price, like $100,000 per ton.
it's skyrocketed.
Not happened in 145 years, according to an article I read.
That's crazy. Imagine that happening in oil. Nobody would be able to. I guess somebody paid a smart bet over there, and somebody shorted it, and some short squeeze happened
Mhm.
as a result. I think it's
Yep.
one of the dealers there in China. I forgot the name that got short
Mhm.
squeezed, and J.P. Morgan had to lend them some money, and one more China bank. I think China Construction Bank, if I'm not mistaken. So
Exactly.
global equity funds. So this is the fund flows weekly. So this was released on March 4th. It's been 6 days. So it says here investors offloaded global equity funds worth a net $13.09 billion, their largest weekly net selling since December. Meanwhile, they rushed for safety as they put nearly $16 billion in money market funds. So European stocks were under intense selling. Financials as a sector also experienced net selling. Their biggest outflows, banks. Banks experienced a lot of selling last week.
Mhm.
So and these investors are putting their money in money market funds to try to probably stock up for a heavy rain.
Mhm.
And this is another fund flow study by Seeking Alpha. I think it would show about the same information. Let's see. Yep, money market funds almost 40 billion inflows, while equity funds almost 2 billion inflows. So people were definitely bearish last week. I wonder how it would be this weekend as they tally the fund flows.
Yeah, they're keeping some dry powder because they're expecting things to go down some more.
Mm-hmm.
So an opportunistic play in
Yep.
is being set up.
Yep. Well, I would like to see what retail investors are doing though. Once the study comes up, we'll definitely share it here in this podcast. This
Well,
article. Mhm.
I think we can trend that once the Fed rate goes up. We can
Yep.
really see how they're gonna react.
Right. We'll figure out. It's coming up soon, less than 5 days or less than a week.
Mhm.
Next article it says here entitled "U.S. inflation hit fresh 40-year high of 7.9%, even before oil spike." So we're probably gonna have probably near 10%, as what one of the Wall Street pundits have said this month. Gasoline, food, rent drove February's monthly price increases. Fed seen starting a series of interest rates hikes next week, like what we've been discussing since the start of this podcast, Wowie.
Mhm.
Despite that, there's another bullish article somehow. U.S. household net worth jumps to a record on equities, housing, real estate, stocks combined 4 trillion in fourth quarter. Business debt outstanding rose an annualized 1.2 trillion. So people are house rich at this point in time because of the increase in values of their household or house prices, house value, equity, and stock market investments.
Mhm. Yeah, and unfortunately, that's also a sign that the gap between the wealthy and the poor has also increased.
Yep, one of the cases for sure, for especially for those renters compared to homeowners. They have no way to
Mhm.
catch up in building that equity, especially if we enter the downturn moving forward.
Mhm.
And as we have been carefully looking at, as consumer is the one that drives the US market economy, consumer credit outstanding, not included in mortgage, rose an annualized 302 billion in the fourth quarter. So consumers are still spending. Oh, so this is one of the things that I would just like to highlight, I guess, because I saw this um Twitter snapshot where one of the Kentucky retirement fund was heavily invested in Russia.
Oh.
And like, yeah, it was published a couple days ago. It was trending at one point. This is a report by the local newspaper there. So Kentucky teacher pension system officials fires back after investment found linked to major Russian bank. So I think they are the top 3 biggest investors in Sberbank of Russia. Sberbank is like the JP Morgan in Russia for listeners who are not familiar. So
How large is their exposure?
about 3 million loss incurred when the shares were sold last month, it said. They were the second largest shareholder of the Russian bank. But they kind of, like, here, Kentucky amassed $15 million stake in Sberbank over several years, beginning 2017. And because of worldwide sanctions, the pension sold its shares on February 23, one day before Russia invaded Ukraine. Can you believe that? So one day before Russia invaded Ukraine, they were able to pull out all their investments in Sberbank.
That was good.
So
Probably save a whole lot for doing that,
yeah, well, they lost 3 million before the banks got frozen over
They could have
there.
lost more.
Yeah, probably the whole 15 million instead of 3 million. It says here they have $30 million invested in 2 funds with stake in Russian companies. So it brings into mind my interest in looking one of the cities close to you, Wowie, Tyler.
Mm-hmm.
So Tyler has their fund. It's called Tyler Firemen's Relief and Retirement Fund. So it's not really like that hard to figure out which companies a company or a retirement fund is invested in. So this may not be updated though, as this has been published in 2019, I think, or 2020. Yeah, 2019. Look.
Mm-hmm.
So most of the investments here in this Tyler fund are invested in Loomis, Brandywine, Vanguard.
Mm-hmm.
About 11% of the, well, that's the return. Well, it doesn't show their overall exposure. But they have William Blair, Diamond, Invesco, Goldman Sachs, they're invested, Vanguard, T. Rowe. Most of these are funds too, funds of funds. So they
Mm-hmm.
have a total of $74.5 million. And their target return is 7.6% a year with a time
Mhm.
horizon of 30 years.
Mm-hmm.
So it's quite interesting. So it's never, hard to dissect or find out. If you're a government official or government worker trying to find out where your hard-earned money is invested in, might as well Google your retirement funds investment holdings. It's always free. You just have to look for it.
I think a quick glance, the Tyler Fireman's Pension Fund looks good.
Mm-hmm. It looks like
Looks
they're
like
well diversified and they're not invested in Russia.
number 1 rule right now.
Yeah. And here's an article from Financial Times. PIMCO stands to lose billions if Russia defaults on its debt. Fund manager exposed to derivatives bet of at least 1.1 billion and holds 1.5 billion in sovereign funds. So even though the Wall Street is well known with its finesse and strategy and investments, they still are exposed normally to
Yeah.
these kinds of nobody is an exemption.
That's true.
I don't know.
But who is you shared this on our group, who is buying up all these bonds, these corporate debts that are in Russia right now?
So it was, let me see if I can get Goldman and JP Morgan are buying these corporate bonds in Russia.
I see. Let me see. Okay, I think that's the thing, you have to back read.
Right. But the thing is, right, this morning, 4 hours ago, it's been reported that both banks are actually unwinding their business in Russia. Goldman
So-
Sachs, JP Morgan unwinding business in Russia. So I don't
Okay.
think they're gonna pursue buying up any corporate bonds anytime soon if that's the case. So probably initially they thought it was a bargain. Here we go. The bank Goldman Sachs is exposed $650 million to Moscow or Russia. The biggest exposed US bank is Citigroup,
Mhm.
operating in Russia. Citigroup has a total of nearly $10 billion, warned that in a severe stress scenario, it might lose half of that or $5 billion. JP Morgan has an exposure of about, well, these are investment banking income. JP Morgan generated 33 million income. That's like how much they pay their CEO. So,
So
uh,
that's
yeah,
not a yeah.
it's not like for us, the 1 million is really good amount of money, but for the bank itself, I don't think they see that as a big amount. Morgan Stanley generated 27 million in income. Citigroup generated 23 million. Goldman, almost 20 million income in Russia. So I don't think they're going to be pushing through with corporate bonds buying, but we'll
I
see.
see. Well, the only bank that, according to the news, that's staying there is Deutsche Bank.
Deutsche Bank, the bank from that's the JP Morgan of Germany, as I would
Mhm.
like to picture it that way. So this is a good news for Amazon stockholders out there. They came out with a report yesterday that the board has agreed to do a stock split, 20:1 stock split. So if basing it today's price, 20:1, 2,900, that will fall somewhere in around $130, $140 a share. So this is closely following what Google is about to do in June. So I'm not sure about the dates. Let's see if this has a date.
So that's very
Uh,
exciting for some of our group members that are invested in Amazon.
yes,
So,
finally
mhm. Congratulations.
you get to jump in. Here we go. That will provide shareholder of record close of May 27 with 19 additional shares. So if you have Amazon stock by May 27, you will be granted 19 additional shares for each one held on or about June 3rd. Okay. Trading expected to begin split adjusted on June 6. So the split would occur on June 6. So if you have a share, one stock right now, you'll have 19 shares by then. So doing a little bit of math, that would equate to around 130 or 140 bucks a share. So there, on the next article, according to Bloomberg, due to the shaky markets brought by geopolitical tensions in the war and in ongoing inflation, M&A has started to slow down, which is kind of like a bad, not a bad, but kind of like a dampener for Wall Street activity. And this is an article from Albany Herald. Oh no, it's included in this podcast because it's something that Goldman Sachs kind of like released. So Goldman Sachs said the world may be facing one of the largest energy shocks ever. So just prepare. Always make sure that you have some exposure to energy, as this might be a, not might be a transitory. It's a bad word now, I guess. And before we end the show, I guess I'm just gonna highlight this stock. None other than Alibaba. So I myself have bought this stock thinking that it was cheap at 160 bucks. Then it fell to 140. Then it fell to 120, 110. I sold at 110, very low price. I thought I could buy it 30 days after to, let the washout period take place and then I could reposition myself. But just today alone, it's down 7.9%. Not a good sight at 92 bucks, almost 93. So if you're going to track its history, it has lost 70% since its all-time high back in October 2020. And if you're going to trace it back when it listed in the stock market, IPO'd in September 19, 2014, it's lower than that at this point in time. Very cheap, as I would say. I do not recommend people buying or going all in on this stock. It's very risky. The China Taiwan issues have increased, so anything can go haywire if that happens. Hopefully not, but this stock is a favorite of Charlie Munger. In fact,
Mhm.
he invested a bunch of money in last quarter, around $110 to $120, I think. So it goes without saying that this stock is a value company. I mean,
Yes.
how can you say that it's not a worthwhile investment if it can generate $242 billion in Chinese yuan and profit about $21 billion with a profit margin of 8.5%. So
So
it's
if you think, like Charlie Munger, right? You see an opportunity,
it could be an opportunity, but
as
yeah, it has been an opportunity though for a while. It's been going down. It's burning pockets worldwide for sure. So, well, before we end, Wally, do we have any quote for the week?
yeah, so we better be like Charlie Munger, right? So from Rudyard Kipling, if you can keep your head when all around you are losing theirs, yours is the world and everything that's in it.
That's a really good quote, Wally. I used to go back to that quote when I feel like really down and I need some pointers to clear my head. So I guess that sticks with discipline as well in terms of investing. That to stick with your plan if everything goes well. Hopefully in the long run it'll bounce back up or give us the return that it should yield. Well, Wally, thank you so much for coming on this evening. I appreciate your time. And
Thank you, Mark.
you're welcome. Listeners, that does it for this episode. Send your questions to markuwawishow@gmail.com or tweet me at markuDPT. Remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing out.
Wawi Santos signing out.